Hi y'all, welcome to the Human and Machine Crypto channel, where we talk to the teams developing some of the hottest technologies in the blockchain space. My name is Hikaru, also known as Machine. So today we have our special co-host Sue, and I learned a lot from her, so really glad to have her on board today. Sue, how's it going?
I'm good. How are you?
Yeah, I'm doing great as always. We're really great to have more people on board and continue to educate the community.
Yeah, definitely. I
Yeah.
am stoked to be here.
Exactly. So speaking of education, right, we speak to top industry leaders in the industry. Who are we speaking to today?
Today we're speaking with Jonathan Libby. He is the founder of Steady State.
Steady State, okay. What kind of company are they?
They are a decentralized finance insurance company.
Okay. Decentralized finance insurance. That's quite a mouthful. Yeah,
Yeah,
even I messed up there. Got it. So when it comes to DeFi insurance, what pops up in your mind?
I mean, I'm it's very new for me. So if I think of insurance, I think of home insurance or like car insurance, but DeFi insurance, I'm not sure what to think of that.
Exactly. I've kind of vaguely heard about it, but it's still like a black box for me.
Yeah, it's something completely, not completely new, but newer.
Right, right.
Yeah.
So then how can I learn more? What should I do about this?
Well, we have to see what Jonathan has to say. Make sure you like, share, and subscribe to this channel and its latest content.
So today we are speaking to Jonathan Libby, founder of Steady State, a DeFi insurance protocol. Jonathan, thank you for being here. How's it going?
Yeah, great to be here. It's going really well. Good morning here in the US.
Tell us more about you. What's your background and how did you start this company?
Yeah, so my background, I kind of have a varied amount of experience in DeFi and as well as finance. I have worked in insurance, both in the institutional and the alternative sphere. And I've learned under like some of the most talented people in the sphere, in my opinion, former CFOs at AIG and former executives at the Lloyds of London, some of the most prestigious insurance firms in the space. And also, I became first really exposed to DeFi when I learned about Pool Together. It's a no loss lottery where you can like inject stable coins, and the growth of everyone's stable coins turns into weekly prizes. And that, as a finance nerd, interest that generated you could pull out whenever, daily or hourly, blew my mind. And so I eventually noticed like this is some really powerful stuff. And eventually I knew I had to get involved with DeFi. And so that was fall 2019. 2020 moving on, I started actively becoming a contributor in the space, being involved in different governance forums, and my passion was almost reinvigorated when I saw Yearn Finance, which blew my mind to a new level, where you had Compound and Aave, these lending protocols that pool together used to grow the interest rates, a new aggregator where I could install DAI into a system and then it would pull from from like the capital aggregate into this Yearn pool into the largest APY pool, whether Aave, Compound, or other protocols that had the lending rate, and you could always get the highest APY possible in the savings account. And it blew my mind again because I realized, how imagine if this was like in the real world of finance, where savings banks were forced to shoot their interest rates up to remain relevant, because if not, then they can't actually get the APY because someone's moving the money constantly with computer code to like always make sure you or me are getting the highest rate of interest. And that after a year in finance, like I was already trying to contribute to space. I just knew I had to be a part of it. And I started thinking about what is the greatest proposition, I think, or most convicting argument I think DeFi in its current state could bring to the institutional sphere to really legitimize it as a space. In investing, if you get 10 to 12% annually on your investing, you're considered to be doing very, very well. As us, as APY, DGen, Moon coin people, we think that's crazy. But that's the reality.
Yeah.
And that's on investing in high risk stocks, trying to get that 10, maybe 20% if you're lucky. And I thought one of the most convicting propositions you can make in DeFi was a bond that paid 10 to 15% that could give you the same payout as one of those high risk investments, but at a lower cost of risk. And I started putting propositions all across governance forums and saying, hey, I think bonds make sense. We should try to make this. Here's how you build it. Eventually, people start reaching out to me, starting to hear, okay, this is actually really interesting. I want to hear you out. And one of the groups that actually reached out to me was some co-founders at yield.app, a co-founder at yield.app. And they asked me to send some stuff over, and we started keeping the conversation going. And months later, we reinvigorated that conversation about how we believe we could turn this bonds idea into actually a brand new kind of insurance concept. Steady State is actually trying to turn insurance or business insurance into a financial market that creates an attractive payout for anyone while getting effective coverages for businesses. And that's what we're really trying to do. It's really exciting stuff we're doing at Steady State. We're building it out and we're really pumped.
Right.
But yeah, that's kind of how Steady State came to be.
Okay. Yeah, no, awesome story. We're completely with you, right? All these new products and DeFi solutions coming out, we're just blown away every single time. So to kind of backtrack, right, and to really illustrate for the audience, when it comes to insurance, okay, we all know what it is. However, DeFi insurance is quite a new thing. So can you kind of explain what are the core fundamental problems associated to this DeFi insurance?
Well, I think there are a lot of, but first we go into the fundamental problems of DeFi insurance. Let's start I think it's important to talk about the risks we all acknowledge are there in that space that we haven't fully figured out how to effectively cover. A lot of it, when you start building insurance, you want insurance for coverage from unknown events or catastrophe events. And the catastrophe events we're always worried about is exploits, bugs, flash loan attacks, or something market systematic. I remember the Maker DAO died depegged for a period of time. I believe it was very early last year. That was scary for everyone if anyone had died. And suddenly your DAI is worth 70 cents. You're like, oh my God, like, is this the future? And that's when the DAO governance came in and fixed it and made it a much better system, in my opinion. But that's market systematic and technological risks are two of the key fundamental risks we identify and are constantly exposed to by being involved in this Wild West space that we're trying to develop together. Currently, the real key way people are the other risk is derivative APY movements. Like, APYs suddenly go from 1,000 to 100 to 5 and trying to get some kind of coverage on that. But we're not really focused on that right now, so I won't go into that as much. But currently the solution people have created is retail investors can get coverage on their downside risk of these catastrophe events and all these different protocols through a mutual system where you and I can offer collateral or capital, say stablecoins DAI, and then you can get coverage with the capital we provide, and you pay us a premium for covering that. It's and when insurance is filed for these events, you and me, the capital providers, vote on whether or not that person gets our money or our insurance. That, I think, is one of the biggest ways to understand, I think, where we're at in the space. The industry is starting to really shift and realizing the mutual perspective, philosophically and in theory, is really great. How do you eliminate human error, get a lot of people in to come and contest with each other in the free market of thought, and then try to figure out what's the truth? The application has gotten very interesting results. One time, a protocol file, people arguing, well, this is actually a bug attack or an exploit or a flash loan, and saying, well, you're covered for this and this, but not this. And because this was implicated to causing this, you're not covered. But it was still this, like what you were covered for. And it creates like a really weird, interesting system where retail investors are exposed to people arguing a system we don't fully understand yet. And they're trying to get coverage in like all these systems we don't understand yet, saying, well, actually, flash loans are really implicated with bugs, which are actually implicated with impact on other financial systems. And you should be getting insured if there's the implication there of other variables. And that's kind of where we're at in the state. Where the industry is starting to move, I'm noticing, with Risk Harbor and Sherlock DeFi and other protocols on Slash and what we're building, we kind of all come to different conclusions, different results or outputs, but similar conclusions that insurance, we live in a world of logic and public transparent data on a blockchain. We should be able to make insurance eliminate human error by eliminating as much human interaction as possible with insurance rather than increasing it. And we believe automated smart contract solutions are the way to do that. And we believe it's possible totally with the data provided through crypto and within the blockchain sphere.
Yeah, so like you said, in the DeFi space, like rug pull, protocol hacks, and smart contract bugs are more common than we like it to be. So if an event happens, how is the event like paid for? If an insured event needs to be paid.
In the current system, or how we plan to do it?
How you plan to do it?
So our approach currently is we're looking to build automated smart contract solutions for business insurance. We live under the belief that it's really crazy, in my opinion, that us, the retail investors, have to get coverage on every single investment, whether Curve, EFI, Uniswap, for catastrophe events related to the business, not directly related with our own investments. So, and how it works in conventional business, if the token price moves, well, that's on us. Like if the stock price moves, but if someone bought, like if I bought something like from a bank and had in say a savings account, and my money just disappeared, it's the bank's job to get me covered, not mine. And then when we invest in liquidity pools, if our money gets stolen, it's our responsibility to recover it. In one sense, in crypto, yes, I agree. You know, the individual sovereignty, not your keys, not your wallet, great. But also, businesses, the risk should also be moved on to businesses as well, where if these fundamental catastrophe risks are related to the protocol more than us, the individual, they should be building and uplifting their communities and their own project by covering their downside. So what we're looking to do is create an automated smart contract business insurance for technological and market systematic risks. When an event occurs, we believe all these different events, Oracle nodes can be used to detect when an event is happening. And we believe a protocol can provide data to suggest what kind of event it is. When that event actually happens, the money gets then put into a lockup period, a 10, 15-day lockup period for people to evaluate for fraud or bad actor activity. But the protocol gets paid back that payment of whatever they're owed. That payment is not necessarily a total loss. I don't believe you can automate a total loss coverage. Say if you have $100 million pools and $100 million is lost, it's really hard to cover that just because there's a lot of unknowns. But if you take insurance and actually mirror it to a bond market system, when a business releases bonds, they say, I have $20 million of risk I'm willing to sell. And people can buy that risk and receive a premium for covering that risk of debt being paid. In a parametric approach, which is a form of insurance, if a parametric insurance is used for catastrophe events and they use transparent, open data to agree upon if these criteria of an event happens on a mathematical or transparent or like calculable scale, you get covered the average rate of loss that is agreed upon pre to the event rather than when the event occurs. If you look at the evidence, if you ignore rug pulls, let's say, because you can't cover rug pulls of business insurance because you can't insure fraud. You can't. It's about we can't insure it's all the other things the good protocols are responsible for. And so if a protocol, say the average rate of loss right now is $20 million, well, let's actually up it to 30 million because the TVL and DeFi is growing dramatically. So imagine the rate of loss or exploit loss will increase dramatically. The average rate of loss is $30 million. Rather than insuring, say, a $100 million pool in agreement, because it's going to say then you $100 million and then you lose $120 million. Well, because the pool grows since the agreed upon insurance, well, you can't cover that. What you can cover is whatever the agreed upon terms of agreement are in an automated system and what the risk is taken on initially and cover that and actually agree upon that. And what we're trying to do with that approach is we believe when bonds are posted, an exchange maybe will buy it, but really what happens is a business posts it and they hold it. And then people can opt in their own money to buy that and receive the premium in advance. I believe we can do that same method with business insurance and crypto. All these protocols have massive treasuries of money they don't know what to do with. And they say it's locked up with a multi-sig or a Web3 wallet or however they're going to plan to hold it. And it's exposed to all these different kinds of risks. Why not use it and acknowledge by covering your downside and acknowledging your own downside and creating a payout to cover that downside?
Right.
And that's what we're trying to build. And we believe if you post a $20, $30 million policy as a business, say Aave, and they're going to pay a 20% rate of return in Aave tokens, you and me can stake the collateral and actually receive, say, $100 and receive a 20% rate of return in Aave tokens for staking collateral in the coverage. And when the automated smart contract, and rather than agreeing between a group of people to vote on whether or not you get insured, the smart contract decides what happens. And if the smart contract is wrong, after it's approved and gets put in that claims frozen process, we have a 10 to 15-day period to evaluate it as individuals if we think, and we have to provide proof of fraud if an event actually occurs.
So, okay,
that's what we're looking to build as a whole.
Right, it sounds very comprehensive. So just to paint an example, right? Let's imagine retail investors, myself and Sue. Let's say we're using a DeFi platform, and that platform is using steady state, in the back end. So Let's say, I put in 100 US dollars worth of crypto. Will that business have, like, say, templated, insurance contracts that I can opt in to buy? For example, level one, here's what happens, or level two, and I pay like a premium.
Yeah. So here's where it gets interesting. We're base layer logical insurance. As a protocol, you could actually find profit opportunities where you could post your own downside, buy it, and then pay yourself to cover your own downside. And for you, the user, if a protocol wanted to go this route, they could offer different opportunities and protocols for you on contract basis to actually opt into to get that coverage. That baseline coverage is available for the protocol. So you, the user, are covered if you put $100, say, if you have $30 million coverage on a $30 million pool, in theory, you're covered. But say that pool ups to $100 million and they own the downside, say they actually buy their own risk, like all their bonds, and hold it, then they could put different opportunities for you to get your own kind of insurance based on what they have available in a policy hold as a total. And that's what they could possibly do. It's meant to be gamified. Our kind of market goal is we're trying to create a clean process, an attractive process for many peoples. And how we do that is through customizability. So we just cover the insurance for the protocol. What they offer to you is up to them. And what they want to give to you and what they bring to you is up to them. All we want to make sure that you, the business themselves, get that level of coverage that they should be responsible for covering, because it's their risk that you're taking on every time you work in their system.
Right, right. So would you say that moving forward for all DeFi or maybe even fintech, right, using some sort of crypto, do you think DeFi insurance, like yours, for example, should be the standard for all businesses?
We're talking with a lot of people about that. And the thing about insurance is there are many different needs. I believe we can be that fundamental base layer of insurance for all protocols. How we're building it out, and we can go into details of the more system later if we have time, but how we're trying to build this out is actually thinking about that fundamental layer and trying to build that fundamental base layer across all of DeFi. Rather than retailers getting covered for their downside, I think the fundamental layer should be businesses and good protocols getting covered on their downside. And we can make it into an attractive payout system for everyone. Let's say, um, um, let's say you as a trader you can't get the amount of Aave you want token payout by just liquidity mining or APY, normal APY methods. But you want higher exposure to Aave, and you're investing in Aave and want to cover your downside. What if you offered $100 into business insurance into Aave, or 200 or whatever, or 500, and your payout was like a 20% rate of return in Aave tokens? That becomes an attractive measure where you can actually accumulate well by taking on the risk of actively covering the downside that you're already exposed to by being involved with Aave.
Right, interesting.
So that's how we kind of see it happening, is if you can build a fundamental layer of different payout and opportunities and different return opportunities and different incentives for different groups of people, then in many different ways, and create an interesting payout solution that brings that available, not just on the protocol side and on the insurance side on both ends. We believe that customizability and malleability makes it that ability to be that fundamental layer.
So I have a question. If I search decentralized finance insurance, which I know nothing about, a couple of names comes up. How is your project different from similar projects?
I would say three really great protocols to think about that I believe have held a pretty good handle on the insurance sphere that also have different markets. I would say is Cover Protocol, Nexus Mutual, and let's say Barn Bridge. Nexus Mutual, when you get insurance and when you want to file for insurance to go through a claim system, it's built on that mutual system we talked about initially, where people opt in capital and you provide the capital, and I vote on whether or not you get my money for what I agreed to pay you. And we've seen mixed results from that. Ours removes the human error by putting in mathematical measures and building the automated smart contract system. Human error, by creating a proof of fraud, by data to prove the smart contract is wrong, you actually eliminate the human error even more by saying no one can just challenge a claim. You have to provide evidence the claim can be challenged. That's how I would say we vastly differ from Nexus Mutual. We actually, with Cover Protocol, they're a peer-to-peer exchange. Often, if you look at that, they kind of focus on protocols that offer high APY, but the high APY is 100, plus often, I'm noticing. And we want to focus on covering the top 100, top 200 DeFi index protocols we believe are going to survive a bear market. We want to create that fundamental base layer for bear market covered protocols that are going to survive bear markets, and these tokens are going to be much more valuable in a bull market afterwards. So what we are focusing on is really being that base layer for for good protocols and trying to be that fundamental. We're trying to incentivize good capital markets, which is moving short-term plays into investments to long-term investments, which is really hard to do in crypto. But if we can start investing and covering the protocols that do, in my opinion, like Aave and Yearn Finance, hopefully you can start incentivizing better capital markets across the whole system of crypto by letting you know that if I'm a whale, if I'm a trader, if I'm a staker or a community member, I can park capital and know I'm covered to some layer and know that I'm safe by just putting money here and not thinking about it for once. I tell you what, all I ever do when I'm in crypto is think about my cryptos. It's brutal, and imagine not having to worry about it going missing one day and actually having that fundamental layer and seeing, well, Curve has that, Yearn has that, and Yield and all these different groups. It brings more peace of mind, I think, in this Tantalus system.
No, for sure, man. I mean, crypto, for the people who's in it, even for us, right, it's still pretty scary to just think about your seeds or like, is this DeFi protocol going to get hacked tomorrow? So I definitely agree.
Yeah,
I got wrecked by a cartoon panda on Sushi Swap last summer. So I mean, we're all victims of DeFi and all these different rug pulls and events.
Exactly.
But, yeah.
Yeah. So like in terms of user experience, I know we're talking about DeFi and crypto specifically, but as DeFi grows, right, I personally believe that it's going to fuse or become the next fintech and eventually replace the legacy systems. So when you think of insurance, right, in a traditional world, it's really dreadful. You fill out hundreds of paperwork, you go through hours of calls and argue, and it takes like weeks to months. Do you think these smart contract-based insurance can eventually replace all of that to automate it?
So there are, at the key categorical level, in my opinion, there are two forms of insurance. One is called parametric, and one is called indemnification. Indemnification is kind of what often when you get in a car accident or you get life insurance, where if you're not agree upon what's going to be paid out, you just agree you're covered for something, but the payout of what you're going to get varies based on the level of loss or damage in an accident. When people have to go in and evaluate what happened and it's uncertain who's responsible for what or what the data is and what happens, we are not in a place yet where automated smart contracts and data can be used to figure that out. But we are in a place with a parametric approach. If the values are transparent, available, if we can make it categorical data that can be logically understood by any kind of system, and that it is transparent on any kind of blockchain, and the loss coverage is agreed upon pre to the event, that can be covered through automated smart contracts. The insurance industry has not seen any significant change in the last 100 years. It is one of the most highly regulated space and sphere, and the greatest, most powerful, in my opinion, creation was something called insurance-linked securities, which is reinsurance and people being able to buy a new system that actually I kind of modeled some of my idea off of, the most innovative part of insurance. The reason why is because of all these regulations, all these different rules. I believe automated smart contracts, if you can prove the event is possible, this will be really disruptive for insurance. Not for first world countries necessarily, but for the countries that need it. The third world countries are exposed to a lot of different risks. Farmers, miners, people who are really, trying to actually the ones really running this world in the back end, and getting businesses and people that fundamentally have coverage on an automated system. And by building out them, we can actually disrupt insurance if we prove this is possible, not at the top, but at the bottom and work our way up. And that's the method and view I think we need to have when we build insurance in crypto, and how we're going to bring it to the real world. The real world.
Could you give us some example of like the top use case used by your partners or clients?
What was that?
Can you give us the top use case used by your partners or clients?
Yeah. So one of the coolest things we want to build in this protocol I haven't talked about are index pools. Because you're not actually covered necessarily, you post coverage and then people opt in capital, you actually have the real opportunity as a business insurance provider to actually get 100% of collateralization available to you, 100% collateralized insurance on an automated mass system, which is really attractive for the business. But it's going to be really, really hard in this capital intensive system to get that 20, 30, $40 million coverage for each protocol initially. If I'm a protocol like Yield and I have 80%, say I post my insurance and I get 80% collateral, and then Yearn Finance, say, has 80%, and Uniswap and Curve has 80%, I believe this is one of the most attractive systems. We're building a system where people can combine their collateral together into a larger pool. And then everyone gets that 100% collateral, where each protocol now, say, with these 4 protocols, are almost 400% collateralized and backed. But it actually gets them that 100% layer of coverage at the same time needed. How this is great for the user. Say, if I put $100 into any of these different insurance pools, so that's our use case for the business side. And they can start combining their capital and actually cover their downside more effectively by combining their collateral together with other businesses that they trust and want to work with. If I'm a user, why is this attractive for me? If I put $100, say, in Yearn Finance coverage on $30 million policy, the likeliness, if an event does occur, that my number is going to go to zero, is like, if it go to zero, I'm probably going to lose all that money because we're covering the average downside loss. What if rather than parking into one of these pools, I could park into a pool attached to all these other pools, like some kind of a bespoke fund, or collateralize all these pools into one pool comparatively. If say you have 5 pools, let's say Uniswap, Pool Together, Curve, Yield, and Yearn Finance in one pool, I can stake $100 here. If one of these guys file insurance, my chance of loss, let's say, is 20%. But my payout, let's say, is 30% based on these averages. And my payout is a mixture of 5 different tokens. Let's scale that. 100 DeFi protocols collateralized into one pool. And each in this pool, your exposure by staking money in this pool is 1%. By staking $100 in a black swan event, let's say 5 protocols in the top 100 DeFi index and market cap file for insurance in a black swan, my rate of loss potential is $5. My payout is a 30% rate of return in 100 different tokens. And that's our use case for businesses, where you can get that collateral coverage. And for the other people, a staker, think as a whale. And you're in a bear market, you don't have to buy. Why not just park capital here? At least you're acknowledging your loss and your coverage. If you're a trader and you know what to invest in, you know what to buy, why not just park capital and then just until you find the next big trade and pull out? And you're getting a really good coverage, risk managed coverage, and getting a good rate of return. As a community member, why not buy the coverage of your own protocol and cover your downside they already exposed to? There are many different return opportunities and arbitrage opportunities for our 2 markets: the protocol posting the downside risk, and then people who want to stake funds to get coverage. And our goal is to make it a really effective, liquid, powerful market that can create attractive payouts for everyone. That's kind of our use case.
Yeah, wow. That's a lot of information. So how can the community become more involved with your platform?
Yeah, so to become more involved, we have a Telegram, Steady State DeFi. We have a Twitter, Steady State DeFi, and we're going to be releasing really material very soon about all these different concepts I'm talking about on paper. Someone to really sit down and read through, okay, what the heck am I getting involved in? And what we really want is that real engagement where people can start looking at, these guys have really well thought out these solutions and these problems, and they're very serious. They can see the value of not only creating business insurance, but the first of its kind fixed income market sphere in crypto, and covering 2 of the biggest fundamental needs you need in a financial market in one swing, and realizing the real value. And what we're looking to do is community members who want to be as engaged with us, who want to be involved in the long term with a DAO and want to build this system out with us. So we're looking for guys to actually engage in the Telegram, ask questions. Feel free to reach out to me or any of my team members. If we never DM first, but if you want to DM us, feel free to. And and reach out to us and we can talk about the concept together, right. Jump on calls. And really, I'm really invested not only in building this project, but building the community that can take this way farther than any one person possibly can. Because my goal is to build a DAO system to build this out. So if you want to get involved, we have a Twitter, we have a Telegram, we're releasing material and marketing material soon to show to you guys. Why not get involved and then really try to build this out with us? Offer criticism, offer approach, want to learn more, and then ideally be ready to take over a DAO system and build this with us in the long term. Because I believe a DAO is the most effective way. So I want my community to get active and involved so we can get that DAO focus.
Exactly. Yeah, no, it's completely true. Even for our community, of course, we want them to really learn, right, about your platform, your technology. But not only that, be part of the community, be part of the DAO. And because this industry is just evolving naturally that way, I think that's really the only way to grow this whole DeFi sphere. Yeah.
100%.
Yeah.
Yeah.
So
I'm glad we're on the
yeah,
same
yeah,
page.
exactly. All of us here. So, that being said, this was a very, very well thought conversation. We definitely learned a lot, but unfortunately, time is up and we will like to conclude it. But as always, right, we like to follow up with projects, 3-6 months down the road to really talk about the progress, how the industry has evolved, how your platform has evolved. So, yeah, when you have time, feel free to hit us up and we can always do another follow-up interview. Yeah. So thank you so much, Jonathan.
I'd love to. Thank you guys for having me on board.
All right. Wow, that was a lot of dense information. Sue, what did you think?
Well, the idea of having insurance in DeFi is, it's mandatory. DeFi is like still very new, still evolving, still changing, and it is quite scary.
Right.
Yeah, and you need this peace of mind of a good insurance project where you can rely on when something bad happens.
Completely agreed. But, from the conversation with Jonathan, it really seems like this whole insurance thing is complex, no doubt.
Yeah.
In the traditional world, and then in crypto, it's just not there yet, right? It's still very much evolving. So
yeah, I mean, I didn't even know that the insurance we have in the DeFi space now is not automated. It's by voting.
right.
Yeah, so this concept of having it automated is actually fascinating.
It is, yeah, not just automating, but really making it so streamlined and user-friendly, right?
Right, user-friendly.
One thing I liked is that he's saying this insurance should be for businesses. And the end users, right, just reap the benefits. It makes it easy, rather than the users having to worry about it themselves, which sucks.
Right.
Yeah, cool. So what was another thing that stood out to you?
Another thing that stood out to me.
Yeah, for example, what did you think of Jonathan? A very smart guy, huh?
Yeah, very smart.
Yeah.
He seems like very passionate. And I like one thing that he said was if you have any criticism or like, things you don't like or, comments you want to make about the project, let him know. And it's just all about like building the space and making it stronger. And like crypto is made for the people.
Absolutely, yeah.
Yeah.
It's a collaborative, open model.
Right.
Yeah. Great. So, even for me, that was a lot to take in, but I'm actually very pumped. I think I'm going to go study more about DeFi insurance after this. And we highly encourage that for the community as well. So, go explore Steady State, learn about DeFi insurance, follow their socials, our socials, and yeah, just have an open mind, and we encourage you to come back. So that's it for this video. Thanks for listening in.
Bye.
Bye.